right, I want to thank everyone for coming out today for the tutorial. Today is Monday, November the 5th, 2018, and this is a quick tutorial on options trading. We'll go over options trading on stocks and options trading on commodity futures. All right. There is some information, further information on options. If you go to the tutorials folder in the trading room files, you'll see that there as far as additional information. In addition to that, let's see, there's something else I was going to say. I know there's another. Oh, that's right. If you also go to, let's see, is it in tutorials? No. Okay, it's in the it says trading room files or something like that. I'll probably have to rename some of these folders. But if you go in there, there is a folder about, I think it's actually called options or stock options or something. Anyway, there's a folder with word options in it. If you go in that folder, there is several books that I posted in there for you guys on options trading, okay? And different strategies, everything from what the floor traders used back in the day and things of that nature. So we'll get in some of the, we'll deal with some of those basics stuff today. All right, so let's get started. All right, for sake of complexity and ease, I'm going to use the TD Ameritrade Think or Swim trading platform. What I'm going to show you though is pretty much how you would do it on any platform. All right, and that's how we're going to roll. All right, so the first thing you want to do is you want to decide what is it that I want to do in the market. Trading options is no different than trading, straight equities or trading straight futures contracts. The analysis and everything is pretty much the same. You have to first determine, do you want to go long or do you want to go short? Okay. Now, options give you, pardon the pun, more options when you're trading. It is impossible for me to take a neutral position if I buy X amount of shares of stock. However, I can take a neutral position if I use options, stock options, purely stock options. All right, so there's a myriad of different trading strategies and their types of options plays that you can use. There's everything from the simple all the way to the complex. And this video is not intended to be an all-in-all about options trading. It's just going over some basic stuff that I do when I do trade options, which is rarely. I almost never do it because I like just buying straight out shares, and I like buying, straight out futures contracts because I like the liquidity. I like to be able to get in and out of the market, and it's just better for me that way. I just like that better. But I realize that for some people, options trading is a more viable strategy, especially if you have a smaller size trading account. All right, so let's just use an example. We're going to do the stocks first, and then we'll go into futures. So I'm going to base this off of a question I got this morning regarding GM. So we're going to come up to General Motors. All right, just like you would anything else, you're going to look at the chart. This is the weekly chart right here, And you're seeing right now this is in a downtrend channel. All right, it's in a bear market because your trend lines and your price action is trading below the Kumo cloud, so you're bearish. All right, the market has since rallied off of its lows, but you do realize and notice that this is a strong resistance right here, right? This orange line is strong resistance, and the market is having a problem getting above it. All right, so we'll say this is around the $37 handle. It's having a problem with it. Can it break up and go beyond that? It probably will, but then you got more resistance at the bottom of the Kumo cloud at 38.5. So you have to determine, since you're trading with options, you have to ask yourself a question. What's your time horizon? What do you think the market's going to do? If you're bullish the stock, obviously you think it's going to go up. Do you think it's going to go up like quickly in the near term because some news or something's coming out, or you have taken a longer term view? My general rule of thumb when I am buying just straight options, I'm not doing any type of spreads or anything like that, I look at least a 90-day expiration, because options are designed to go to zero at expiration. That is the idea, all right? So they have a time restraint on them. When you're trading when you trade options on stocks, you can go out further with what is called leaps. Those are longer term options that generally go out 2 years. Now, the pros and the cons of buying options that are further out as far as expiration is concerned. The pro of that is obviously you're going to have more time. You're going to have a whole lot more time to make your decision. You don't have to, you don't have to have the market move in your favor right away. All right. So that's a plus. It gives you some time. And on the positive side, you can ignore short-term price fluctuations in the market because you have a longer-term outlook. Okay. What does that mean? Well, it means that you're going to have to pay for that privilege. All right. So because you're buying an option that's further out, you're going to have to pay an extra, what is called premium for that advantage. All right. So you're going to pay a higher price than someone would pay, let's say, with a stock. With an option that's about to expire in 30 days. All right. So options have what is called premiums built into them. All right. That premium goes to the seller of the option, who is assuming unlimited liability on the situation. All right. It is a fact that the people who usually make money trading options in the longer term are those who write options, or the sellers of options. You can sell covered options or you can sell naked options. All right. Covered options meaning let's say you own 1,000 shares of GM. A way to hedge against downside risk is let's say you want to sell some calls. You can sell calls. That's a covered option at that point. It's a covered call. It's a covered call because you own the underlying shares. It would be a naked call if you didn't own the underlying shares. Writing naked calls is not only extremely risky, but also foolish. The reason being is because there's no limit on how high prices can go. All right, prices can go to infinity. All right, it's just how it is. Prices can go to infinity. So if you write a naked call option, you are assuming unlimited liability. All right, because prices can go to infinity. When you're writing naked puts or selling put options and you don't own the underlying shares, your risk is not unlimited. Your risk is limited because prices can only go to zero. All right. So therefore, most people who write options or sell naked options, they usually sell puts, because when you sell a put, again, your liability is limited to zero because prices can only go to zero. So case in point, if I sold a put on GM right now is trading, as you can see, at $36.18. Therefore, if I were to sell an option on that right now, sell a put, let's say I wanted to sell a $36 put. All right, that $36 put is considered out of the money because it is trading below where the market is. All right, it will be considered in the money if the put that I was selling, let's say I was selling a $37 put. That put's already in the money, right? Because it's a 37 strike. Therefore, I will be selling an in the money put. All right, so I'm going to make more money if I sold the in the money put than I would if I sold an out of the money put. If I sold the $36 put. Reason being is because it's out of the money. Market hasn't gotten there yet. It needs to get there. In order for, we're going to flip the script a little bit now. All right, so we've touched on selling. We'll get back to that later. Let's talk about buying. If the easiest position in trading options is to buy them flat out. So you buy a flat out call, you buy a flat out put. All right. When you buy a call or you buy a put, you have limited liability in the situation. The most you can lose when you're buying a call or a put is what you pay for that option. All right. That's the most you can lose. You do not have unlimited liability if you buy a put or a call. All right. Just remember that in order for you to make money, you need for the market to settle on a call. The market needs to settle above the strike price. On a put, the market needs to settle below your strike price. Okay? That's how you make money. If the market does the opposite, then you lose money. And if you hold the option until expiration and it's out of the money, then you're going to lose 100% of what you paid for that option plus commissions. Okay? Again, keep in mind options are designed to go to zero at expiration. So let's get into the option screen so you can get a better look of what we're talking about. So in this one here, I can go right here to monitor, go to trade, and now I'm going to type in GM. All right, as you can see, a thing comes up, and this is your options chain, okay? Your options chain comes up. Now, here you see your weeklies. These have weekly expirations, and then you have these that don't have that. So what I'm looking for here is I want to find out, like I told you, I normally go 90 days out. That's just me. You can do whatever you want, obviously. Here we are in November, so I would need to go out to like January or March. So let's just go March. Let's look at what March is looking like. All right. So as you can see here, on the left-hand side of the screen is your call strike prices. See right here it says calls. On the right-hand side of the screen it says puts. These are all your puts. And you see how it's kind of like lightly highlighted or tinted, however you want to say it. And where these two meet is where the market is at the money. Okay. And you can see right here 36 is where that is. So on the put side, all these puts here that are highlighted are in the money. Okay. These down here are out of the money. Notice how the options are priced. You have your bid and you have your ask. See, bid and ask. These are the people, this is what they're saying they're looking to buy it for. Here is what the people who are selling it are asking for that. All right. Notice how it gets lower the lower the price you go down. The reason being is because they're saying that there's absolutely no chance, almost zero chance, that it's going to be settling below $23 by expiration. That's why these are priced this way. Okay. These are out of the money puts, or deep out of the money, however you want to say it. All right. So unless you really think that the market is going to, this GM stock is going to crash within the next 90 days, then buying the out of the money would be foolish. If you're expecting a huge move, it could top send GM below $23 before the 90-day expiry, then it would behoove you to go and buy this because it's 17 cents. You're only paying 17 cents for the 23 puts. So you could buy a whole boatload of that. But when you come up here, the $36 put, they want, $2.73. All right, so it's way more expensive because you're closer to the money. Now let's look at these deep in the money puts. Let's look at this, the 55. It's going for almost $20. All right. Now let me explain to you the difference between the in the monies and the out of the monies and why you may want to do that. Buying in the money puts is almost equivalent to buying the stock shares outright. All right. Once you get to a 1-to-1 ratio, that's what you're looking for. And you're going to get that when you go in the money. All right. So that's how you get that. So if I bought the 37, 38, 39, 40, I'm in the money already. And it has a higher probability that the put is going to settle, the market's going to settle below my put price. All right. The next thing you want to look at too, when you're looking at buying a put or a call, you want to look over here at the open interest. All right, the volume doesn't really tell you nothing, but the open interest does. It lets you know that you're not alone at a particular strike price. You really want to find strikes that have the highest open interest. If you go way over here, you have almost no open interest, meaning that you're alone. You'll be by yourself if you purchase this, okay? But it looks like everyone's grouped in around here, the majority. Now there is, you can see 14,536, individuals at the $30 strike price. All right, that's out of the money. So let's say, for sake of argument, you wanted to purchase a particular strike, but to do so outright is expensive. Like for instance, the 37, it's going for $3.30. You're like, that's really, really expensive. What can I do? What can I do? You can do what is called a bear put spread. There are bull call spreads and there are bear put spreads. What that means is you buy a strike and sell a strike to help pay for the strike that you want. So that's kind of like doing that. So like in this case here, you would, it's been a long time since I've done these. I hate, for the record, I hate bull call and bear put spreads, but we're going to talk about it now. So basically you're buying one strike price and selling the other. All right, so that's how that works. So let's see here. You would come in, you would let's say you would buy the 40 for $5.30, and then you would sell the 3.30. All right. By doing that, the difference between the two basically is what it's going to cost you. So you're cutting your cost that way, but you also limit how much money you can make because the market needs, like I said, to close below the strike price in order for you to start making money. So that's how that works. All right. You limit your money when you do that. Just like, let's say you were long GM, let's say from $30, right? And you're afraid that the market is going to drop. You will come over here. All right, so you're already long from 30. Come over here and you're like, man, I need to make some money. I need to hedge. So you may come over here and say, I'm going to sell the 31 call and take in $6.15 a premium. Now, doing that is equivalent to putting on a stop, putting a stop on your trade. All right. But you're not going to do that. You don't want to do a stop because with the fluctuations in the market, you could get stopped out. So instead of doing that, you sell a call. All right. So that's the pro of that. Here's the con. The con is you can make no more than $1 on this trade, meaning that if the stock settles above $31, the most you can make is $1. Even if the stock goes to 31 and then jumps to 40, you can only make $1. You only make the 31. All right. The person you sold the call to will end up exercising you, and then you would end up, taking your profit at 31. So that's how that will work. When you sell calls against your long stock positions, you are limiting how much profit you can make. All right. So just remember that. Even if you say, well, that's too close, I'm not going to do that. I'm going to go way out and sell the 40. I'll take in $1.22 in premium, and that should give me a little bit of cushion in the short term without having to use a stop. Okay, that's cool. And 9 times out of 10, you're going to get to keep that 122, because it looks like there's no chance for the stock to settle above 40 within the next 90 days. You see where I'm going? So that's kind of how you do it. Now, there's another strategy. All right, it's a synthetic position. You do this strategy when you have a longer term outlook and you expect the market to move in a certain way, but you also know that due to the volatility and price fluctuations, you don't want to get stopped out prematurely, and you don't want to use a stop loss. So what you do is you buy insurance. This is an expensive strategy, but it is a strategy in which, if done correctly, even if you're wrong on your direction in the market and on the trade, this is a trade that you can virtually not lose on. Technically speaking, this is a trade where even if you're wrong, you can still make money. It's expensive, and it's only if you expect, explosive move, in your direction. All right. And if done correctly, all right, there's a high degree of probability that you will not lose money on this trade. All right. Even if you're wrong, you can unwind it and still be in profit. I know the question is, well, why don't most people use this? Well, because everything that you do has pros and cons. All right, let's get into it. In this synthetic strategy, once again, you own GM at $30. All right. This is how you would do this strategy. If you put the strategy on after the fact, there's a higher degree of probability that you will lose a little something on the trade if you're wrong. You have to put this trade on simultaneously. So if you were looking to buy GM when it was at $30, you have to put this strategy on immediately at the same time that you put this on, okay? So let's say we'll use what it is now. It's at 36.23. You think it's going to close above 40 within the next 90 days, all right? So what you do is you say, I need to get long this stock, but I don't want to use a stop, and I need protection. So you go in, and let's say you'll buy the 37 call, okay? You buy the 37 call over here. Excuse me. I lost my train of thought that quick. What was I saying? All right. In the GM, it's at 36.23. You're gonna come in here, and you're going to, let's see, because you're about to buy it right now at the market. You want to go in, and you probably, let's say you're gonna buy the $40 in the money put, and then you're gonna buy this at market. Price is at 36.24 now. You go ahead and buy that at the market, and you go ahead and buy this put too. All right, you want to buy this in the money put immediately. Now, here's how this works. You bought the $40 put, which is deep in the money. Market's at 36. You bought that at the market. The reason why you would do this strategy is because you now have about $4 built in to this position, meaning that if the market were to tank and go south and this stock drops to like 23, you would take a bath on your long stock position but you would make up for it in your put that you have, which is a $40 put. Now, here's how this works. Your loss will be limited because you're in the money on the put. So the way you have to do this is, the way you do it, if you're wrong way before it gets to expiration, because remember, you have what is called time decay on options. The closer it gets to expiration, the more exponentially it loses its value. And this price right here drops exponentially. So here's what you do. If you're wrong, let's say 30 days into it, 45 days max, you have to go ahead and unwind. You sell out on this long position and take profit on your put. So your put will make up for the loss you took on here, because the put right now is more than a 1-to-1 ratio. All right, that's why you buy deep in the money puts when you're going to do a long stock position. Likewise, if you were shorting, it'd be the same thing. All right, so that's how that works. Only do this if you expect the market to do, like I said, a huge move within a limited time period. There's a myriad of strategies when you're trading options. I don't use any of them. I don't do condors and butterflies and all that stuff. If I use the option, I'm going to pretty much either buy a put straight out, or buy straight calls, or do the synthetic position I just showed you. That's what I do. All right. So if you wanted to come in here, let's just do it. Say you want to buy this. You want to buy it right now. If I click this, trade screen comes up. All right. I can work my price with a limit. All right. And see if I get filled. Just hit the confirm send. It'll tell you either you don't have enough money, or for how you have it set up, or whatever. And the account that I'm using is a dummy account, so it's probably gonna say I don't have enough money. Let's see. All right, it comes up right here. It tells you how much it's gonna cost to do this. All right, and there it is. It's how much it costs. All right, because I put here, look, 10 contracts. One option is equal to 100 shares of stock. Being that I put 10 here, that's equal to 1,000 shares of stock. Okay, so keep that in mind as well. All right, you can also do options on commodity futures. Remember, commodity futures contracts have an expiration date. So at some point, they're going to expire, and then you'll have to roll over to the next month, or I could say front month. But again, this technique is pretty much the same. Just with futures, you're going to pay a lot more. Let's use an example here. We'll do the E-mini S&P. Let's bring that up. All right. Like I said, it's been a while since I've done these, so please bear with me. All right. I'm going to go out to... I'm just going to go to March, just for the sake of argument now. We'll go to March. All right, here we go. Futures is a little bit different, and it's expensive. If I'm going to buy the at-the-money put in the S&P right now is at 27.30. So let's say I'm going to buy, I may want to buy the 27.40. I'm going to pay 113.25. When it comes to futures, that price right there, that 113.25, that's telling you that those are points. With futures, those are literally points. So this is going to cost you quite a bit. Let me pull it up and show you. Like I say, a price I don't have enough, but let me just see. All right, $54,000 if I'm going to sell these 10 puts. All right, because I put it in the short, selling puts. Now, the reason why is because it's charging you, when it says 100, that means it's charging you 100 points, and the E-mini S&P moves in $50 increments. So that's $50 a point. So a full point or 400 points it's $5,000. And I said, I'm trying to sell 10 of these bad boys. So it's going to be 54,000. When you're taking unlimited risk positions like this would be, when you're trading futures, it's unlimited loss, not limited loss like equities. All right. Futures, they don't go to zero, not normally anyway. They have done it in the past, but generally speaking, because you're dealing with leverage, upwards of 50 to 1, your loss is unlimited when you trade futures. If you take short positions, like if you're going to sell puts or sell calls, it's unlimited risk either way because these are futures and they're leveraged instruments. All right, capiche? So what the futures industry does, they do something what is called span margin. That's what span margin. Don't even get me to try to explain to you because it's complicated. It's a formula that they use to determine risk and liability. It's based on a billion different things. At the end of the day, it could be whatever they want it to be. They look at how much money you have in your account. They look at your previous style of trading. They look at a lot of stuff, and then they have a formula to determine how much they're going to charge you for that position and how much you have to maintain in your account as maintenance margin to hold it. When you're trading futures, there's initial margin and there's maintenance margin. Okay? Initial margin is how much it's going to cost you to initiate the particular trade you want to do. And then maintenance margin is how much it will cost you to hold it overnight. Okay? Now, if I'm going to come over here and I just want to buy, the put outright, I'm going to fix this so you can see. See, now that's reflective. $5,687.50 is what it's going to cost me to buy that put. Okay? And the reason being is because they want 113.75 points. All right? So you may just be, why not just trade the futures outright? Why not just go in and short even the S&P? Me, that's what I would do. I wouldn't go in and do a put because there's no way to escape the liability. If you buy this put and the market settles above this price, then you've lost all your money. That 5,000 is gone. Bye-bye. You feel me? I know what you're thinking. Well, you can always get out of the thing. You don't have to hold it in the expiration. That's true, but you're still going to take a loss. You don't know how the time decay is going to affect by the time you get close to expiration. Remember, they lose value exponentially the closer they get to expiration. Okay. Now I know there's a thing called the Greeks where you're looking at beta and theta and all that other. I don't get into all of that. I really don't. That's just me. If you want to have a deeper understanding of that, go ahead and read some of the options books that I put in there because they tell you what's what. Seriously, that's going to help you out a lot. But I pulled it up here. Here's delta, gamma, theta, vega. I don't remember what all that stuff means, to be quite honest with you, because I don't trade options like that. I have no idea. One of these, the reason I pulled it up, because one of these tells you what the correlation, the one-to-one correlation is. That's what you're looking for. You're looking for the one-to-one correlation, like I was explaining to you before. That's how you do it. And if you go, here it is. This is 1.1. It's all the way down here to the 22.50 strike price. All right, so basically that's pretty much it in a nutshell. Same principles. Just remember, with futures, is unlimited risk when you do naked positions. Now, if I was already long the S&P 500 from, let's say, 27 even, I'm 30 points in the money right now. Let's say I'm flat, but I think the S&P is going to go through the moon within the next, 90 days. Like I told you, you go ahead and buy this right now at the market, and then you're going to want to go in here and you're going to want to buy the in-the-money put. All right, you may want to go with the 27.80, 27.70, something like that. Like I say, you're going to pay a lot of money to put it on. But in case you're wrong and the market tanks from here, well, guess what? This is it's going to gain in value exponentially. You're going to lose money on this position. It's going to look nasty on paper, but when you unwind it, you take your loss on here and then unwind this one. This will cover the loss on this, so you end up walking away with a couple of dollars. All right, so that's how that works. All right. Any questions up to this point? Any questions up to this point? Think of a good one. Like I said, for more details, and you really want to get down and dirty and look at all the strategies that are there and available to you. Like I said, I do have the resources. If you go to the tutorials tab, I'm sure you'll see it there. But really, the strategies that I use, if I think the market's going up, I would buy a deep in the money call. That's just how I do it. And if I think the market's going down, then I buy a deep in the money put. And like I said, I like to go at least 90 days out. When you're trading the stock index futures, they trade in 4 expiration months to reflect the 4 quarters of the business cycle. So you have March contract, you have your June contract, and you have your September contract, and then you have your December contract. Okay, so good question. All right, can you relate the sheet to which option you would choose based on the price triggers? Okay, let's do that. All right, we're gonna go back to the equity one. Let's go to the General Motors. All right, let's go to the March on the General Motors. Okay, let's pull up the sheet and see what's up. I don't have it open, so I gotta open it. Just gotta wait for it to open a bit. I thought I had it open already, my bad. See, the NASDAQ's down 60 points while the Dow's up 150. Yeah, that sounds about right. All right, so let's make this bigger. All right, let's go to, where did I do it at? All right. Oops. All right. Why isn't it coming up? Okay, hold on here. Oh man, Excel. Okay, let's go. All right, let's see. Okay, here we go. GM right here. All right. General Motors, we got it. All right, so on the sheet on the daily tab, coming into today, if you look at GM, you see that you have an uptrend reading. All right, and you have locked in momentum on there. You do not have any negative alerts, no sell signals. You have a continuation pattern buy signal. The entry price is at $36.42. All right, for 52 week at $37.37. All right, and the example that we have up here, let's make this small again. All right, GM is at $36.28 right now. All right, so the entry was 36.42. Let's see. Let's come here. Let's see what the daily looks like. What do we do today? All right, so it hasn't triggered yet. It's not triggered yet. So I don't know how to do it in this platform because, like I say, I have not done it. But there is a way. This is what I would look to do. Make sure my broker had it and have them walk me through it. This is what I would do today with the sheet. Okay. So we know that there is a buy in the sheet today, but the entry price is at 36.42 and 37.37 respectfully. So what you could do is you make this, let's make this small. All right, let's see, 36.42. All right, you could either, if it were me, I would go ahead and buy the 37 call. All right, I would buy the 37 call if the 36.42 is triggered. And there's a way with a conditional order where you can type in, buy me the 37 call at the market if 36.42 on the underlying stock price is met. And it'll do it for you. It'll go ahead and do it. All right. So that's how I do it, because strike prices, they move in dollar increments. There's no, $36.42 or whatever. It's either 36 or the 37 is the one you would buy. All right. If you wanted to buy the 36, you had to go in there and start working your price right now. But I wouldn't do that. And the reason being because it hasn't triggered my price yet, which means the market is not yet moving in my favor. See what I'm saying? If you were to go in and just buy it outright, you're saying, okay, I think it's going to trigger. You know what I mean? And it may not. That's why the price triggers are so important, because if the price trigger is not hit, then you're not in the trade. So find out if your broker has the conditional order type where you can say, if the underlying hits this price, then buy me this strike at the market. Does that make sense? That's how that works. Same thing on the put side. Let's say today was a short, calling for a short in this one, and it says shorted at 36. Once again, I'll put the conditional order type in, buy me the 36 strike put if, at the market, if 36, is triggered in the underlining, and they'll go ahead and it'll do it for you. That's how you do that. Does that answer your question? Yeah, you have to round. You have to round it. When you're buying, I always round up when I'm buying, and I always round down when I'm selling. All right. Once again, you want to round up when you're buying and round down when you're selling. That's how that works. If you want to be truly organic to the system and use the strike price, use the price triggers as your entry price, that is how you would do it with the options. Now, if you were just looking at a chart and saying, we're in a bull market, I think this thing is going to run. Yeah, I like it. If you were going to do it that way, without using the price triggers, then you go ahead and you would need to buy in the money call option. All right. And me, I would go as deep in the money as I could. I want to get close to 1-to-1 ratio as possible. So this is at 0.92. This one right here. This is 0.92. It's higher. It's the highest. So I go in and I would buy the $24 strike right now and work my price. That's what I would do. That's how you would do that. Whenever you're buying an outright call and you're not using the price triggers, that's how I would do it. And if you would, and that's another strategy for using the price trigger, same thing. But you just don't want to buy the option unless the market is triggered and moving in your space. So likewise, using the same example, instead of buying the 37 call, if 36.42 is hit, you can say, buy me this. Oh, now I said one. Buy me the $23 call if 36.42 is met. All right. There is a reason and a rationale for buying deep in the money when you're doing it like that. There's a lot of different nuances to it. For one, it's going to move point for point and tick for tick with your underlining. That's why you want to buy deep in the money options, because you want that 1-to-1 ratio. These right here are farther out. They're not going to track with the underlying market. This one right here, between these two, this right here, see how it says 1.0? That's your strike. You want to buy the 1.0 strike whenever you're buying options, because that means it is on par with the underlying market, meaning that this strike price is going to move tick for tick with this stock. You follow me? That's what that means. This call option is going to move tick for tick with the underlying market. The rest of these will not. They will only move a percentage of the market. So if this thing goes rip roaring to the upside, this thing is only going to track at 54%. You dig? Because look, it's a 0.54 delta. The only Greek I look at is delta, because delta gives you your ratio. You want the 1-to-1 ratio or higher if you can get it. Okay? So you want the 1.0 or higher. You don't want lower. You don't want it to track only 90% of the move. All right? And look at these that are deep out of the money. They're going to only track the market 7%. See what I'm saying? That's how these things are priced. Options are very, very well priced to reflect probabilities in the market. 1-to-1 ratio at all times. So that's how you use the pulse wave price triggers with options. You buy either at the money, or if you can afford it, you buy the 1-to-1 ratio. If we lived in a perfect world, every time I buy a put or a call outright, I would buy the 1-to-1 ratio once my price triggers were hit. Okay, yeah. The question is, can I do one more on today's in play tab? Yeah, which one do you have in mind? Which ticker? JDST. All right, let's do it. JDST. All right, JDST. Coming into today, you have no sell alerts, but you do have a buy alert. You have a 911 rally alert on the JDST. All right, as far as trend is concerned, it's in an uptrend. You have a stage 3 mature uptrend. And likewise, the entry price is at $70.82. And both the entry and the 52-week are the same, meaning that if this is hit, if this is triggered, the market is going to run. So let's see what JDST is doing. All right, it's at 68. All right, so you're not triggered yet, but it'll be the same thing. You would say if that price is met, then go ahead and buy me the 70 call. at market, or you would go and say, nope, 1-to-1 ratio, buy me the $35 call, and you'll work your price. You can buy it at market or work your price. If the price is triggered, same scenario. So back to the sheet. The actual price is $70.82. Like I said, if it hits $70.82, you would come in, you could buy the 70 or the 71 call at the market, or you could buy the 1-to-1 ratio, which is better because it's going to track it penny for penny, and that's the $35 call. You got it? Or you can make this cheaper too. Like I said, you could do the bull call spread. You could buy the $35 call, right, for the 1-to-1 ratio, and then you could sell, let's say you could sell the 70 or whatever. You just throwing that out there. That's how a bull call spread looks. So you would take in this premium against what you had to purchase here for the $35. So instead of paying $35, you could get it down to maybe $25. But in order to make money, the market has to settle above, the strike that you sell, the further out strike. So in this case, it'd be like the 68 or 70. Market needs to close above that in order for you to make money. All right. All right. Anybody else? Good questions. Yeah. So like I said, the bull call and bear put spreads, the way it works is on a bull call spread, you're buying the at the money or the in the money, and then you're selling the further out. And like I said, there's no right or wrong way to do a bull call spread per se. It's up to you. Just remember, with me, I like to buy in the money options. So if I was going to do it, I would buy any one of these in the money options and then sell the at the money one. So again, I think the market's going to settle above $68 within the next 90 days. I buy 35, sell to 68. That's how that works. If the market settles anywhere below there, all right, you are losing money. You need the market to settle above the strike price that you sold. All right, that's how that works. All right, someone posted, I actually like to buy out of money, long dated option, either a hit or a total loss. Yeah, I mean that's the gambler's mentality. I used to do it every now and then, but that's not that's not the way I like to do it. You know me, man. I like to make money, man. I don't like losing. I like to win. You know. But hey, there people. All right. Case in point. Since you brought that up, because that is funny. When I used to work on the street, all right, as a broker, people would come in. They say they would want to buy this 142 call. I'm not kidding. They buy knowing that there's not a chance in four worlds of the JDST closing at $142 within the next 90 days, and the price of the premium reflects that. They want $4.10. All right, and if you buy this, it's only going to track the market 0.15%. Now, if the market does get on a bull tear, then this price would start to go up, and you make money. These are home run type swings, all right? They're gambles, all right? You're not going to make any money unless something extreme happens, okay? We would laugh when people want to do it because they think they big pimping because they come in here and they can get this for $4, they load up on it, right? And they're just hoping that the market moves some kind of way so they can, make profit on it. But the rationale behind it, I give you the pros and the cons. The pros is by paying this little bit of premium, the market doesn't need to close above 142. You just want to see your premium double or triple so you can get out of it and take profit. All right. So people see this as a viable option, no pun intended, to go in and to buy these. Now let's take a look, because you will be surprised how many people are actually doing this. You would be surprised. Ding, 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 ding. 114 souls have bought this $4.10 option, the 142 call. 114 people. 10 people bought this one. 10 people bought this one. See what I'm saying? People do this. People do this. You got 700 at the 80 and 643 at the 79 strike price. All right. People do buy those deep money options. So just like HK said, it is a strategy, and it is hit or miss. It's just not for me. Now, let me hedge that, because I got to be honest. I'm gonna give y'all fair, honest stuff, truthful stuff. If I were to do an option, something like this would be the market to do it in, because it's a 3x ETF. The JDST is. So something that's volatile and moves, like even the stock index futures, you could possibly do a trade like this and actually make some money. Once again, though, you're hoping that it's enough movement and volatility to cause this to go up, and you're hoping that you can get out of it. Your open interest, only 114, and there's no volume. Volume is good because it lets you know what the average daily liquidity is looking like in a particular option. As you can see, there's no volume in any of these joints. You got people holding them, but you do not have any volume. So they're not really trading like that. Yeah, most options traders lose, almost like 100% of the time. The people who are making the money are the writers, but again, most writers are writers of puts, not calls. You gotta have some brass ones to be selling naked calls. I don't care if it's futures. I don't care if it's stocks, because that's unlimited risk, and markets can go to infinity. There's nothing saying that this JDST, when you wake up tomorrow morning, could be priced at $3,000. And if that happens, and here you are, you wrote an $80 call, or you wrote 10 of them joints, you bankrupt now, because these calls, it's not gonna be $10. It's gonna be $1,000. Then what you gonna do? And remember, each call or put option is equal to 100 shares of stock. So just keep that in mind. Really, you want to buy strikes that have good open interest and good liquidity. 9 times out of 10, the ones that have the highest open interest normally would have the best liquidity. Now, this is, to be fair, this is a March strike price. So we are like, 4 months out. You know what I mean? If I were to come in and do, let's see, hold on. Let's say I didn't do March. Let's say I went into December. All right. It's a little bit different story, as you can see. A little bit different. A lot more open interest. All right. You even got a little bit of volume today, too, around the 67 and the 70 strike price. Like I said, normally, well, as far as liquidity goes, liquidity has the instrument that you're trading. That's number one. If the instrument that you're trading doesn't have a lot of, open interest in daily volume, then you don't want to be in that instrument anyway. But in this one, it seems to be fair. You got all this open interest. You want to be in the hundreds like this. The higher the open interest, the better. But in the money, you don't have to worry about it because, like on this one, you only got 3 open interests at 31 on 31 calls. Doesn't mean you can't get a fill if you go in there and do it. So if you were to buy this $31 strike and the market settles at 70 by expiration, you know, you're settled in cash anyway. When you're long an option and the option settles in your favor, then it's settled in cash anyway. You don't have to do anything. You don't have to get out of it or liquidate it. You only need to liquidate before expiration when you're trying to cut losses or take profit right away. Yeah. So you start off with the open interest. That's a good place to start off at. Just because you see a zero volume, it doesn't mean that there aren't orders standing to be executed in the market or working. This just tracks trades that have gone off and been filled. That's all. All right. Anybody else? Any other questions? I hope this options, training session has got something out of it. At least I hope. I'm not an options guru. I just know how to do what I'm looking to do. And like I said, I don't really trade them all that often. It's been years, to be quite honest, since I even bought an option. I like straight futures or straight equities. Like if I want to operate in JDST, go ahead and buy some shares of JDST. That's how I like to do it. Because I feel like I have more control. And with options, you don't necessarily have that kind of control per se. There's really no market depth when it comes to this. You just have your bid and your ask, and that's it. At least I can look at market depth with the JDST if I was just to buy the shares outright. I like control. I like to be able to really manage my risk when I'm doing something. Can you save this video? Yes. The video is being recorded and will be uploaded to the trading room files. Just like the one I did last week, I recorded it and uploaded it to YouTube. On this one, I'm going to do both. I'll put it for both. No problem. All right. Well, I will see you guys in the trading room then. All right. Thanks for attending, and everybody be encouraged. And remember, take what you can and give nothing back. Don't turn your winning trades into losers. Peace.